So what's happening in the housing market right now? Due to interest rates almost doubling since the beginning of the year and what we're now seeing in the economy, people have stopped buying homes, right? And isn't this going to put an end to crazy home price appreciation that we saw for the last 2 years? Home prices are eventually going to fall, and we should definitely wait for this to happen before buying, right? Now hold on, because we're going to find answers for this today. Hi, welcome to July 2022 Monthly Market Report. We are in very questionable times right now. We are about to face recession in the midst of inflationary times, and I want to start off today with a topic on recession. Because when it comes to recession, there's something very interesting that we need to know. Throughout history, during a recessionary period, interest rates go up at the beginning of the recession. But in order to come out of a recession, interest rates are lowered to stimulate the economy moving forward. Historically, we have seen a repeated uptick in interest rates followed by lowered interest rates. Now, to see if this statement is correct, let's take a look at the actual numbers. This graph represents 30-year fixed mortgage rates going back to the early 70s and what happened to the rates during the recessionary times represented in vertical gray bars. And if you focus on the highlighted boxes, you can see that rates do go up in the beginning part of the recession, but it does come back down as it was stated in the previous quote we just read. Okay, let me take this visual chart and convert it on the table. This chart represents when the recession happened, how long it happened, and changes in the mortgage rates during its course. And as you can see, one thing that all these recessions have in common is that mortgage rates fell. Now, I'm not trying to say in every recession going forward this is going to happen. But if you ask me how would recession affect the real estate market, this is the verified information looking back in the past. And this is what Fortune said in regards to this. Over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact as it takes some time to turn things around, even when the recession is technically over. Now, we know that Fed is working hard to tame inflation. They've slowed down the economy by raising the Fed funds rate. And you probably heard that they're also engineering the soft landing. Because if you don't do this correctly, then we'll be in recession. But unfortunately, the chances of us going into recession is inevitable at this point because we already had negative GDP for the first quarter this year, and the second quarter that we just came out of, I'm starting to hear it was also a negative GDP. And as I've mentioned before, the definition of recession is having negative GDP for the 2 consecutive quarters. Fed knows that impact of housing is tremendous for our economy. Housing has brought us out of the recession, and I believe it will do so again. The Fed also knows that US economy can't recover until housing leads the way out, and this is why we saw the cyclical events of interest rates falling during the recession in the past. And I want to remind you again that recession doesn't equal housing crisis. Out of the 6 recessions we had in the past, home prices appreciated 4 times out of 6. It fell marginally in 1991, but what people remember is 2008, and this somewhat became a new definition of recession for many people. But again, as I've explained to you before, what we're facing now is nowhere close to 2008. Now let's move on and talk about inventory. We know that buyer activity has slowed and more inventories are coming into the market. So is it safe to say that we're moving into the buyer's market? Well, no. Let me explain exactly what's going on with the inventory. Currently in the housing market, numbers of offers being received for a home available for sale has gone down. The average offers being received in April was 5.5 offers, then it dropped to 5 in May, but the latest number released in June reported 4.2. Next, offers over listed prices also dropped. A month ago, offers over listed price was 61% of all the offers, but now that number is at 55%. The numbers of sale has also fallen as well. But what's increasing now is the numbers of inventory. We're going to look at this a little later, but overall, rising interest rate environment has softened the buyer demand, but the market is still quite competitive. And where we are in inventory is still well below the pre-pandemic norm. Now, we need to understand that there aren't tons of inventories coming into the market. It's just that the pace of sale has slowed down. This is how Mark Fleming at First American puts it. There has been a pickup in the inventory that we've seen recently, but it's not from a big increase in new listings, but rather a slowdown in the pace of sales. And remember that month supply measures the inventory of sale relative to the pace of sales. Same inventory, fewer sales, means more month supply. If you look at this graph, we started the year with 1.6 months of inventory, but that number rose to 2.6 months by the end of May. And this is not a huge increase in inventory. More balanced market is considered 6 months of inventory, but we haven't seen that number since 2012. But nonetheless, we're headed towards more normal market, and this is due to new listings coming into the market every month. If we compare the numbers of new listings for this year to last year, the numbers are quite similar every month, but we start to see the numbers rise at a faster pace since April this year. And of course, this is good news to the buyers because more inventory means less competition and more choices available. Now, if we go back to Mark Fleming's quote a moment ago, he said pace of sale is slowing. And this is what that looks like. This graph shows existing home sales, seasonally adjusted annual rate from NAR. And if you look at the green bar on the right, this is how many homes are expected to sell this year if we go on the pace the homes are selling right now. 5.4 million is similar to where we were pre-pandemic, and this is a lot of sales because 2017 to 2019 were considered one of the best years in the housing market. Now, let's talk about the most important subject in today's market report, which is whether you should wait to buy a home or not. This is actually a bigger question than the question about the interest rate. The mortgage payment has gone up significantly, and this is becoming a barrier for home purchase for lots of people. But overall, nobody wants to buy anything that's going to be worth less down the road. And we all want to be in an appreciating asset. So let's elaborate on this. I want to start off with some of these national and local news headlines. The cooling housing market enters into the great deceleration. Home prices decelerate as the housing market downshifts. Buying a home at the wrong time can backfire big time. Here's why it may pay to wait. News headlines like this tends to bring fear and mislead average consumers. Yes, obviously we are in a decelerating time. This eventually had to happen because we can't possibly continue to sustain the appreciation that we saw in the last 2 years. And as I mentioned moments ago, more inventories are coming, and this with rising interest rates are certainly moderating the housing market. But what's important to understand is that deceleration doesn't mean depreciation. Now, there were many homes that were priced aspirationally or above the market value before the shifting market. But now, those homes are going to have to make an adjustment, because pricing correctly is critical in today's market. And if you look at this latest home price forecast for this year from the top 7 experts in the housing market, they're all calling for appreciation. Their combined average is at 8.5%. In the beginning of the year, their forecast average was at 5%, and then it was close to 10% right before the rapid rise in mortgage rates. But now, they're settling for 8.5%. But most importantly, please note that none of these experts are calling for home prices to depreciate this year. And if you'd like to know what's expected beyond this year, this is the Home Price Expectation Survey by Pulsonomics' 100 Distinguished Panel of Experts in the Housing Market conducted in the end of second quarter. And as you can see, they are forecasting 9.3% appreciation for this year, similar to what other experts had forecasted. But moving beyond, they expect the appreciation to be around 3 to 4%, which is very close to average home price appreciation every year for this country at 3.8%. Now, you might be puzzled as to why all these experts are calling for home price appreciation, despite our economy slowing down and even after home prices appreciated at what seems like unsustainable rate for the past 2 years. I want to bring you a quote by Dave Ramsey, which I thought was quite compelling in explaining why the home prices are not going to depreciate. The root issue of what drives house prices almost always is supply and demand. Now, interest rates affect that. When interest rates go up, guess what? Fewer buyers. The demand goes down, thus prices are going to soften or not be as cray-cray as they have been. And that's what we're seeing right now. Okay, so let's break down what Dave Ramsey said. He said, root issue that drives house prices are almost always supply and demand. And here's what that current supply looks like. This graph indicates how many single-family homes were built every year since 1970 in our country. And everything in blue is pre-2008, and what's in gray is post-2008. And as you can see, for the past 14 years, the numbers of homes built were below the 50-year average. Now this year, we are expected to break out and go above the average for the first time since 2008, but we are still way below what we need to fulfill the current demand. So this is the supply, but how about the demand? What does that look like? If you look at this graph, this indicates the number of current populations for each generation. And as you can see, millennials in 3 blue bars are the largest generation behind baby boomers. And statistically, knowing that the age between 20 to 35 is the peak home buying years, you can see that there are huge populations in this age group. And according to NAR, in their recent homebuyer survey, 81% of the first-time homebuyers and 43% of all homebuyers fall in this age group. So by looking at these last two graphs, you can understand why all the experts are calling out for home prices to continue to appreciate. We had lack of supply for the last 14 years, and we still have tremendous population that are moving through the peak home buying years. I know it's hard to take this in, especially where we are now in the economy, because there seems to be so much uncertainty right now. And knowing that nobody wants to buy something that will ultimately lose value, talking about what's going to happen to future home prices can be a sensitive subject. But it's my job as a real estate professional to inform and educate consumers about what's really happening and what's expected to happen in the housing market. I hope you found value in my report today, and I'll see you again next month. Goodbye.